What's up, everybody? We're live. SoFi Weekly. Me, Tannor, Tevis, Riley, and Chris Hager.
Wrong show.
You don't ring a bell? Okay. Chris, what's up? Happy you're here.
Glad to be here.
You guys want to? I've got quite a few things that I want to talk about today. Amit didn't have his Red Bull like he said he was going to, so I did. So I'll take over from here. Sorry, Amit. So first off, maybe we can get a little bit of maybe introductions to Chris, because maybe people don't know him if they haven't seen some of the older episodes. Chris Hager is I don't even know what he does for his full-time job.
I'm a chemical engineer, so I work on a carbon capture technology of all things, actually. I also write kind of for Seeking Alpha, more as a hobby than anything else. And I spend way too much time poring over SoFi investor relations and 10Qs and everything else. So that's, I guess, a little intro to me.
Yeah, we were just talking about how good of a guy he is and how perfect his family is, and now I didn't even know he's solving climate change. So that's what he does for his full-time job, and in between that, it's donating to charity and everything. And here he is to donate his time to us, and he's going to be telling about how he had a conversation with Chris Lapointe, the CFO of SoFi, about everything about stock-based compensation and how it might not be as bad as some people originally believed. So, Chris, do you have anything to show us in terms of visuals or something like this that might help us understand, how SoFi's... Sorry, go ahead.
I can. Let's see. Probably the easiest way is to just pull up my article, and then we can scroll through different things. So I guess kind of as an introduction, we had this Twitter back and forth. And Anthony Noto actually responded to one of our tweets and kind of gave a little bit of information on SBC. And then Michael Rowland, who's another person who you should all follow on Twitter, tweeted, and him and I went back and forth a little bit, trying to kind of figure out some of this stock-based compensation stuff and how different parts of it are expensed and how it all worked out. And then Chris Lapointe the next day came and had like this long thread of like 8 different tweets that kind of clarified some of the stuff that he was talking about. And actually, at that point, I had already emailed investor relations, and they had gotten back to me and said, "Hey, would you want to do a quick 15-minute interview with our CFO Chris Lapointe?" And I felt like, again, I'm just a retail investor. I felt like I didn't deserve that, sort of. So I responded and say, hey, like, if he just wants to answer this, that's fine. I would be totally willing to and honored to be able to, talk to him about these things. But I understand his time's super valuable. And they said, no, we're familiar with your work, and we're if you're willing to, we'd like to set up this interview. So we did.
When they mean familiar with your work, are they talking about your Seeking Alpha content?
So they are talking about my Seeking Alpha content, but at the same time, so during the call, and hopefully I don't get in trouble for saying this, so the call was off the record, and I have to get permission to talk about specific things, but this is not about SoFi at all. But Chris Lapointe had actually mentioned that he'd watched the last time when Darth Chris came on, and I was on last time, that he'd at least seen part of that SoFi Weekly.
Wow.
So the CFO has at least...
Now you can ring the bell.
Watched. There you go.
That's cool, man. That's awesome.
So at least that part of that episode he had watched. So that's cool. So anyway, I got this. It was a 15-20-minute Zoom call where I asked him some questions about SBC and a couple other things. He was really down to earth, really intelligent, well-spoken. I mean, the exact same way you see him in like all of the conferences and, on earnings calls. He's the exact same guy. So that was, I guess, some background.
So this article,
do we want to get into details?
Yeah, I think so, right? You want to
do...
So yeah, we did a Google, or sorry, there's Google's free shout out right there, and I didn't even get paid to say that. So no, on Twitter we did a Twitter Spaces, and Chris joined us, and one of the things that I thought was really insightful was the vesting periods and the prices in which that happens, and what percentage of the overall payment, how much of the performance stock units were actually, or sorry, how much of the stock-based compensation was actually made up of performance-based stock units, which might not even end up coming true, and it might get trashed at the end of the day. And that's something that Chris pointed out really, really well. Both Chris's.
Yeah. So okay, so we'll go over to give a little bit of background. So there's 3 different types of stock-based compensation that they can give to employees, right? There's RSUs, which are restricted stock units. There's performance stock units, which are PSUs, and then there's stock options. So for the purposes of our conversation, we're going to ignore stock options because SoFi has very, very few of them. They make up well under like 1% of the SBC every single quarter. So it's not worth talking about them, right? Like it's just not worth spending the time. If you look at, so we can pull up one graph here real quick, and we'll just look, we'll kind of do this at a high level, and then we'll go more into detail. So let's see, if I present my screen, let's make sure I do this properly. Okay, so can you guys see a graph of stock-based comp? Oh, I can see it. Awesome. Okay.
Wait, Chris, before you continue, how long did it take you to write this whole article?
I mean, once I get into it, it's not that long. It's just like the way Riley knows about my writing method. So I've got 5 kids, and one of them likes to just hang out while he falls asleep. So I actually write the bulk of my articles on my phone for like the 45 minutes that my toddler is in my lap.
Wow.
So I just kind of write that like, and then also I sit down at a computer and write like when I've got time and stuff. But most of like the bulk of the actual writing time is in this. And then it's way more difficult to do research and like look up 10 Qs and data. So I do that while I'm at a computer and like generate the graphs and stuff. But it's usually over the course of a couple of weeks.
So you put a lot of research into making this, basically.
Yeah. So what you see in front of you, this is the stock-based compensation is in orange, the revenue of SoFi is in blue, and then the line at the top is the stock-based compensation as a percentage of revenue. So what I want to kind of focus in on here is basically, so they came public in second quarter of 2021, and then starting in basically fourth quarter of 2021 and all the way through the rest of it, they've had between $77 and $80 million of SBC. So that's been pretty consistent, right? And the way that breaks down is about 1/3 of that, so about 25 to 30 million, is from the performance stock units, and about 50 million of it is from the restricted stock units. So to kind of back up, so restricted stock units vest over time, so they're given to you. So they're given to employees, and the only requirement that those employees have to fulfill in order to be granted those shares is time at the company. So if they're still active when those shares are vesting, then they'll receive those stock-based units. Performance stock units have other performance metrics that are associated with them. And the important part and Tevis covered this also in one of his videos that he did earlier this week, but for the PSUs, the performance stock units, they are tied to the stock price, to SoFi's stock price. And so the way that they gave them, so they gave some of them to Anthony Noto in second quarter of 21, and then a bunch more to the rest of the executive team and the rest of the employees at SoFi in third quarter of 2021. And the restrictions on those are that the stock price has to get to $25 in order for them to get 1/3 of it, to $35 for them to get the second third, and for them to get 100%. So they get 33% of those PSUs granted to them or awarded to them. If the stock price hits $25, they get 2/3. So the next 1/3 vests or gets awarded if the stock price hits 35, and then the final third gets awarded if it hits $45. And that target, so that stock price target, has to be hit before June 1st, 2026. So in the next 3 years, basically, the stock has to either go, in order for them to get all of it, the stock would have to almost 10x from where it's at right now, right? In order for them to get even any of it at all, we have to trade for on an average for 90 days. So a 90-day average, we have to trade above $25 a share.
So 5x.
Yeah, so to summarize this, so for them to get at least a third of these RSUs, we have to at least 5x PSUs. We have to 5x from here for at least 90 days. And for them to get all of it, we have to at least 10x. Now, Chris, in your research, is this something that most companies have as a plan for their top executives as an incentive, or is this unique to SoFi?
So it's not unique to SoFi. The breakdown of RSUs and PSUs and how they structure everything is really unique to each individual company, right? But in general, like this is how companies do SBC do it, right? Like for example, I know that Palantir, you're really into Palantir, and they've been criticized heavily for SBC in the past, but I personally don't know the breakdown on how many of theirs vest just over time versus different stock price versus, there's other targets that you can have for performance stock units too, right? So it could be like an EBIT target, or it could be a GAAP earnings target, or it could just be a revenue target. And so it just depends on the company.
There was one really interesting piece in Chris's article that I sort of want to flag because I think it's like the thesis of the entire bear case, which is that so RSUs, they're given over time, and if a new employee starts at SoFi like tomorrow, they would after a cliff period, so generally like a year gap, they would go into that vesting. So 4 years, or 4 years is standard for most companies. And so in the future, SoFi would continue to give RSUs, which naturally vest over time, but the performance-based units, Chris was mentioning in his article, they're likely not to return. And so that, with the combination of the stock with the revenue continuously going up and the total SBC offered going down, as a percentage of revenue, it's going to come down very quickly over the next couple of years, number one. And then number two, the thing that surprised me very much was the massive variance in terms of the PSU payouts, if it hit or if it didn't hit. I think, Chris, you had a chart with all the major executives at each tranche, what that payout would be. And so if, let's say, SoFi hit $45 by 2026, Noto would be looking at, almost 300 million. And if that doesn't hit and all of those PSUs essentially expire worthless, then the actual, if you break it down per year, the amount lost to his net worth in general, like that opportunity cost, would be absolutely massive. And so it's a gigantic risk for a lot of these executives because a lot of their compensation is PSUs. I'm sure, Chris, you can fill in a lot of the gaps because that was super high summary.
Yeah, I think basically the idea, and B-dubs, I'll get you to your comment and your question in a second. But the basic idea behind this table is that executive incentives are really aligned with investor incentives, because like if the stock price gets to $45 before 2026, that's worth $300 million to Anthony Noto, right? Like that's a huge number. And almost 37 million to Crystal Point, and 34 million to Derek White, right, who's the CEO of Galileo. So the other thing is that there's everyday employees actually got more than half of the PSUs. So there were 23 million PSUs that were granted total. 13 million of those went to rank and file employees, not to the executive team. So like 9 million went to the executive team, right, which is a lot. But more than half of them went to normal employees. So there's lots of employees at SoFi who have this exact same incentive and will benefit if investors benefit. So and if you go back to the SBC, so about $80 million right now of that, like 30 million is paying just for these PSUs. And so for the last year and a half, every single quarter, we've been dragged down by $30 million every single quarter on our bottom line. So that hits GAAP income, right? It ends up being negative GAAP income that does absolutely nothing if we don't get above $25 in three years, if the share price doesn't get up there. So SoFi, like, this is why, like, people will talk about how GAAP is the end all be all, and it is. Like, GAAP is really important, right? It allows apples to apples comparison. It allows for transparency in accounting. Like, there's lots of things that are really, really important, and there's like, it's a necessary thing. But if you don't fully understand it, you don't realize that like $30 million every quarter is going to something that's going to cause zero dilution for shareholders and going to actually cost the company no cash or anything, in like no real money. Like, it's just monopoly money that is on a spreadsheet somewhere. But it's $30 million every single quarter that's dragging on their bottom line that only is actually worth something if they get to $25 a share. right? And so it's just, I just want people to be aware of these things so that they can have the nuance and the context to be able to interpret the earnings correctly.
So
If that makes sense.
it's also like they're not just giving out stock-based comp just to make their employees feel good. The SoFi understands that this SBC that's hurting their GAAP profitability right now only matters if they can hit 25, which will make the options even worth anything in the SBC that they're giving. Because if the price doesn't go up, the stock-based compensation is worthless.
Right. And to be clear, 50 million, which is, well over half, is in RSUs that as long as people stay with the company will vest, right? But even those are being expensed, like the executive RSUs. So they got this bonus, and it's in this same document. Let's see if I can find it real quick. I think it was just right up here. So they got a bunch of PSUs, right? So you can, if I zoom in, you can probably see it a little bit better. But they got a bunch of PSUs. This covers all the details, right? But they also got a bunch of RSUs. But if you look at the fair value of those RSUs versus the shares, the fair value for those shares are all up in like the $20 per share range. And these RSUs are still vesting now, and they're still being expensed now. So the shares that they're getting right now, a portion of them are still being expensed as if the stock price was still like $20 a share. And so you can see again, and that's the proper way to do it with GAAP earnings, and to make sure that you're in line with everything. But the point is that a lot of people just don't understand. They see this SBC and they think, oh, holy crap, it's 20% of revenue that they're just giving out in stock. And the point of my argument isn't to say what's necessarily good or what's bad, but more to just bring clarity to the conversation, right? So that people actually understand and can have an intelligent conversation regarding SBC, rather than these people who get on Twitter and say, the people who get on Twitter and say, he's making 3 times as much as the CEO of JP Morgan Chase, and that's ridiculous. So when they say that, they're talking about on the 10K, it talks about how that he earned, quote unquote, $100 million in 2021, but 94 million of that, which you can see on your screen right here. So 94 million of that is totally, I clicked on the wrong thing. There we go. So 94 million of that is in PSUs, right? So if we don't get to $25 a share before 2026, he actually got $0 from that $94 million that was reported as income, right? And so I just want to bring clarity to the conversation more than anything else. And there's a ton of detail, and there's no way we can get into all the detail during this SoFi Weekly. But
guys,
anyway,
just look at one more time, because the other executives have a fairly even RSU PSU split. But Anthony Noto's split of performance-based units to the normal time vesting, where he only has to stay with the company for a certain period of time, is absolutely insane. This 100 million, that will all disappear if the targets are not hit. And so he very, 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 very much more so than every other executive has skin in the game, because of the disproportionate weighting in performance units as opposed to restricted ones.
And then think about how influential it is whenever he's purchasing shares on top of that with his own money. If he were to just work on the stock alone, he would already have so much skin in the game, but he's also doubling it up to also try to get that, reward with his own money. I'd probably say the only thing is we don't want these, shares to not get vested. We want them to have this money. You look at Tesla, for example, is probably the biggest example that I could think of, where Elon Musk had massive targets to hit around 2019 and then into COVID, where if he were to hit all of those targets, he would become the richest man in the world. I remember talking to my brother about this, and he goes, oh, no, that can't be true. And then look what happened, right? So he hit these insane targets. They held for, I think it was 60 days. And then he ended up actually, vesting those shares. And then obviously he gets rewarded. And because the stock is 10 or 20x throughout that time, no one complains during that time, because they are also getting rich during that time frame.
Chris, real quick, in your article, you say that there is until 2030 a limit that SoFi can dilute shareholders. Do you mind talking about that? Yeah.
So actually, everybody voted on this who's a shareholder. If you did vote in July of 2022, it was they amended the stock-based compensation plan. That was one of the things that we voted on, along with the reverse split and everything else. well, not the reverse split, the ability for the board to do, and the approval for them to have the power to do a reverse split. Anyway, part of that document that you can find, it's an SEC filing, says that the maximum amount that SoFi can award in compensation every single year is 5% of the total outstanding shares on December 31st of the year before. And so the idea is there is actually a cap. So you'll read ridiculous things, and there's even articles on Seeking Alpha where one of the authors says, you know, they're gonna dilute you 25% this year. That's impossible. It's literally impossible to do with stock-based compensation. Now, if they did two Technisys size acquisitions and all the SBC they possibly could in 1 year, then that's possible. But that's ridiculous and isn't going to happen, right? But the maximum that they can give out in dilution is 5% per year. And the other thing is that, like, it won't ever actually be 5% because part of those things, like, there's churn at any company, right? The only way that it would be 5% is if every employee they gave SBC to stayed on through the entirety of vesting all of their shares, which doesn't happen. So to date, about 1/3 of the RSUs that they've granted haven't been awarded. They've been forfeited because people move on and go to different opportunities and other reasons, right? And so approximately, if you go based on empirical evidence, we're probably looking at about 2.2% dilution per year. I think it's probably going to be somewhere closer to 2.8 to 3%, at least in the next few years, which isn't nothing, right? Like, that investors should be aware that dilution is happening, and that it is a risk of holding this stock, is that you will be diluted because they do pay their employees through stock-based compensation. Like, it's happening. It's important. You should understand it. The point is, though, like, if you're growing your revenue 50% and you're tripling your EBITDA, and by this time next year we'll be talking about GAAP profitability, which is what I think will happen, right? Like, the question isn't like, dilution's important to realize, but if you're paying 2.8% dilution in order to get 50% growth, that seems like a reasonable investment to me, which is why I'm continuing to add to my position, right? Like, I'm DCAing into SoFi every single week because I think that the value proposition and the growth far outpaces, the dilution, right? If we only get 2.8% return on this over the next 10 years, it's because of something else, right? It's not because it's because the growth broke, right? It's not necessarily because of dilution or SBC.
One of the things that, like, surprised me the most in that article, Chris, was that after the expensing, if the tranches are not hit, there's no clawbacks or no way to offset that expense. And that's a huge risk taken by the company. Number one, to determine the total amount of PSUs that they want to issue. And number two, to determine what those tranches are. Like, that Monte Carlo simulation is really important because it basically is determining whether we are going to issue them or the price target is hit versus not at all.
Yeah, that's another real weird thing. And I think Throwable also asked that as well, is that, once this money is taken off as a stock-based compensation, it does not come back. Now, it doesn't mean that it's necessarily, disappeared. Like nothing actually happened. So although it looked bad in those old quarters, it's not actually, it won't vest.
Yeah, so part of the expense, and this is the reason that they do this Monte Carlo simulation, is that it, like, mathematically speaking, right, it takes into account the possibility that the stock could never reach those. And that's taken into account to the fair value of the PSUs. And so, like, that's the justification for why you can have, and total, the PSUs are costing the company $220 million in GAAP earnings. Like, that's the total number that is going to be withdrawn from the bottom line based on the PSUs that have been awarded. And you can't get that back. So if in 2026 we're at $24.99 and they never vested, or even if we're at $5, right? Like, whatever the stock price is, as long as it's below 25, none of those vest. They don't cause any dilution. And that $220 million was literally just monopoly money that came off the balance sheet, or not even the balance sheet, right? It doesn't affect the balance sheet at all. It just comes off the earnings. It comes off the bottom line, but it paid for nothing.
Chris, whenever they actually end up, giving Noto his $104 million contract or whatever, is that when the actual, our outstanding share count actually increases, or is it only whenever it vests?
It would be when it vests.
Okay.
So it's I guess to talk about the terminology. So granting is when they give you the PSUs or the RSUs, and vesting is when those PSUs or RSUs turn into shares that then go to the employee.
It's almost like an options contract.
Yeah,
it's like a promise.
You can think of it similarly, right? And so the PSUs were granted back in 2021, right? When the reverse merger happened and it became SoFi instead of IPOE, and they will vest or not vest by June 1st, 2026. So Chris, if they do vest, then those shares will just be added to the total share count, the total shares outstanding.
So, Chris, I had a question. Maybe you can help me, but I was struggling to find this in the article, the discrepancy between the expensing period and the actual tranches being hit. So they have until 2026 to hit the tranches, but they have until Q1 24 to actually expense the 220 million. Is that their decision from the Monte Carlo simulation, or can they extend that to 2026 so it's less of a hit on the financials?
So that's just the way that PSUs end up being expensed. And this was the most confusing part. And this is the reason that I talked to Chris Lapointe, is because I tried to figure this out on my own and I couldn't, right? And so I had to have him kind of explain this to me. But the way that it's the way that money is broken up. So you've got like $220 million, and it's broken up into three. They're called tranches or tranche. I call them tranches. I assume that's the correct pronunciation. I don't even know.
That's what I say.
But so it's three tranches, one for the $25 stocks, one for the $35 target, and one for the $45 target. And each of those are given a servicing period, is what they call it. And so it's a period over which those are going to be expensed. And it has to do with, like we've been talking about, it has to do with the period that or the probability that the stock eventually hits that price. The $25, $35, and $45 price. And so the tranches that are associated with the $25 target have a shorter servicing period than the ones for the $35 and the ones for the $45, which means that they're all three tranches are being expensed right now, right? But eventually, at some point, the $25 tranche will roll off. And so SoFi doesn't give the exact timeline for these. My own kind of digging into the numbers makes me think that some of them might start to roll off already, or might have already rolled off in Q4. And a significant portion, if not all of them, will have rolled off by Q1 of 2023.
So
those would be like a third of the SBC from the PSUs will be gone, and then a little bit longer period later, the $35 ones will roll off, and then finally by the first quarter of 2024, all of it will have been expensed and will roll off.
So
my understanding.
Two more mini questions from me, and then flourish everybody else's. So number one, the servicing period. My understanding is, from what you just said, that's determined when the PSUs are granted. And number two, can that servicing period be changed? Because what I'm thinking of is, if they can extend the servicing period or the expense out to 26, then that looks way better on their numbers, as opposed to 24.
They can't. So this is just part of GAAP accounting, right? That's just the way that you do it. You run a simulation. There's different simulations you can do, Monte Carlo, or there's like something skulls or whatever. Anyway, there's different scenarios you can run. But yeah, that's the one. But once you run it, and once you've established the servicing periods, like the servicing periods are determined by this Monte Carlo method or simulation or whatever, and then it's set in stone from there.
So if we don't get to at least 25 by 2026, is this investment a failure?
I think that's on you to decide.
No, I mean, well, if all this SBC is coming out, and that's it's a question to spark a discussion.
The plus side is you're not going to get diluted anymore, because those PSUs essentially, they're never hit, so they're never issued, or they're never awarded.
Right.
But you take that $220 million hit.
I think a lot of it depends on your cost average. I know you entered the stock much, much later than I did, right? And so my average is way high. I'm not worried about it. I think that SoFi is going to be fine in 5.
I'm actually in the profit right now.
years.
My average is 531 I'm kind of scared. I know everybody's gonna hate me in the comments now.
It's okay. We should be happy for you. I'm happy for you. But I don't know. Like, part of me says yes, that would be a failure, but at the same time, like, that's a 5x in 3 years from here, right? Like, that's a ridiculous return. And I am, averaging down slowly, so my cost basis is coming down. But the other thing is, like, I don't know. Like, I feel like I've been talking too much. We'll listen to you guys.
You're the
Tannor?
guest of honor. I mean, they hear us every single week.
Yeah, great article though. Like,
Yeah,
seriously,
fantastic.
it was so well written. It was like super easy to understand, and it clarified so many points that I didn't really understood at all. So it was amazing.
Do you guys want to jump into some predictions for SoFi and fintech in general?
I want to say one thing that I noticed real quick before you jump into that, and
Yep.
I noticed that SoFi 2 days ago posted a listing for a senior like exec managing like a tech team for building out credit card stuff. So it looks like they're hiring people for credit card development. I don't know what that's going to look. Just know that they're hiring for that, and as well as they're hiring a ton of fraud people. Which only means one thing, that they're expecting to grow really fast, and they're trying to get ahead of the curve because fraud is kind of like an S curve with fintech companies. It comes out of nowhere, and a lot of fraud nowadays are like really, really advanced. So there's probably like fraud happening right now, but it's just like ghost. Like there's a thing that I've been reading that. In fintech, a lot of fraud happens in the early days, and you don't realize it because the accounts are dormant and they wait for a security risk later down on the line when the company has grown a lot faster. And then all of a sudden, all these accounts come active, and then they initiate the fraud at the same time. So they're hiring a ton of fraud, but that is good because it just means that SoFi expects that their members are going to be growing really fast, really quickly.
So this is something that I didn't understand. So whenever I was reading up about Galileo, we had partnered with DataVisor, which is the market leader in fraud detection for online banking. And not only that, e-commerce and all these different things. They are a giant in the space. But so if Galileo is using that, I would assume that in some sort of space that SoFi is using this. So why are we hiring people for our own division of fraud if we also are also like subcontracting that out in a way?
Well, I do know that okay, so like Galileo it does a good job at doing like its own fraud. Like, so that Galileo builds its own tools for like issuing debit cards and all this stuff, and they built really good tools around that to like focus on their own stuff. But DataVisor does a lot more, and they focus specifically on like super complex like machine learning stuff. Then again, I don't know exactly a whole lot, but I just know that SoFi is trying to be like super equipped when it comes to fraud because yeah, go ahead for it.
I wonder, maybe just to sort of answer Tanner's question, maybe you guys know, does the bank charter have any provisions or regulations in place for like a number, like what your AML team needs to be, like anti-money laundering team? Because that could also explain it. The further that they go into in terms of how much money they're handling, that could have a correspondence with what their actual AML team needs to be. But I'm just spitballing.
Potentially. Do you guys want me to share my screen really quick? I can kind of show for the people that have never heard of DataVisor or don't know what I'm talking about.
Just make sure to hide your tabs and you're good.
Yeah. I'm good. A bunch of people see a Notion tab. I don't care. Okay, so fraud management for financial services. This is just one of their things. This is just specifically in banking. Helping combat money laundering, spot call center fraud, secure peer-to-peer transactions, just the full scope. This is not just, they don't just deal in one section. They deal in literally every fraud type in banking, from ACH to checks and everything, even application fraud. So whenever people are actually signing up, fake accounts, transaction fraud, everything. So I just find it weird that we have such a close relationship with them. we even had DataVisor's CEO talk about Galileo and why they are working with us. And then in the next same breath, we're sort of doing it ourselves. So I don't understand. I don't know if that's necessarily a big point, really.
I think
that's just me. I mean, I could be wrong, but like, I looked at DataVisor for our protection, I guess.
I don't know. I think Galileo is very like niche when it comes to our fraud, because the tools that Galileo has built are only like supplementing the products that they provide to other people. So like Robinhood uses our debit card issuing. So Galileo has made like a tool around that to focus on fraud in that area. But DataVisor, yeah, they have clients like all over the place. I don't know if there's anything on that the website about AI. I remember like they had a lot of YouTube videos of people talking about like specific like AI fraud, which is scary as hell to me. I don't know what that's going to look like in a couple of years with the onslaught of ChatGPT. What happened there?
I can't breathe. I lost it. Went down the wrong hole.
Anyway, the main takeaway is hiring more fraud means that we're just going to have more members, and SoFi is dead set on growing like at all costs, because that's the biggest risk is when you have more members, it becomes it's like an S curve for fraud. It gets harder and harder to solve problems. So it's good. It's good news.
Do we want to talk about APY changes? Were there any this week?
Just the self-employed news.
Well,
yeah. Noto just confirmed on Twitter that the 3.75 is going to apply for self-employed individuals. Sorry, go ahead, Tannor.
I can't make this any bigger. I apologize. I tried to make it bigger. It's not getting any bigger, so I apologize.
That is what I said.
Yeah, okay, just throw the screen up. I knew it was coming. So this is actually, and I'm actually in dark mode, so you can't see those little words right there. It says Samsung Money. So this is Samsung Money by SoFi. They are now allowing that our APY will be through your Samsung Money account by SoFi. So at first read, whenever I read this, I immediately thought, okay, so we're actually being a bank sponsor. We can finally take, them on as a client, like through the deposits. Now, the more I read about this actual, relationship with Samsung Money, it doesn't even feel like a Samsung product at all. I don't know how this works. I've messaged SoFi Investor Relations and Anthony Noto. We'll see. A bunch of people are joking about if he's in the chat or not. So if you are, please join in the call and answer this question. And that's all we will ask you, is whether Samsung Money accounts are SoFi accounts, and if it actually works into our product numbers, because I really want to know that. Like, if, I don't know, it's just this big product that we keep showing off, or Samsung is showing off, but then if you actually want customer support, you don't go to Samsung, you go to SoFi. Like, all the emails are SoFi domains and everything. So I don't know how, like, is it our product or is it Samsung's product? I have no idea.
I do know one weird thing is, like, way back when the bank charter news was relevant, I guess it's still irrelevant, but there was a issue that Samsung Pay users had whenever they were when they were closing down their Samsung Pay accounts and then moving over to SoFi. Like, the account numbers like switched or something. There was something that like you couldn't do that. So it is weird. It feels like SoFi just copied and pasted their checking and savings account and then just made it like under the Samsung umbrella. I don't know, but I don't know if that means anything at all, but it is interesting. I don't understand the partnership either.
Gotcha. Okay. I did have something really cool to cover. So I don't know if Chris knows about this or whatever, but Zachary Perret from Plaid, he's the CEO of Plaid.
By the way, before you continue, me and Tevis were talking off camera, and I said, Tevis, how much is Plaid worth? And he said, oh, like $80 billion. And I was like, wait, what? Plaid
80 billion?
Yeah, he thought I meant Stripe, so I was just very confused. But Plaid,
yeah, I was going to say that sounds like way too much.
It's too much. Yes, correct.
But I think I could probably tell you a reasonable price for it. So Plaid was trying to be acquired by Visa back in 2020. So obviously they've grown a ton because that was right before, a massive fintech boom. But back then, Visa tried to acquire them for $5.3 billion. That's what payments.com says. Okay, but this...
First of all, hold on. Amit's hitting me while I'm down trying to fix my camera issues. I mixed it up with Stripe. All right. He waited 40 minutes to see when I was because somebody called me and I recorded my phone and so it froze. And then he's like, you know what? Tevis did something stupid and I can't defend myself. Sorry.
Bro, he was like, oh, they're worth 80
Tanner.
billion. I was like, in what world is Plaid worth 80 billion?
2 seconds later, I was like, oh, wait, I'm thinking of Stripe.
Bro, no. Plaid cannot be worth 80 billion because Plaid shirts don't even cost $80. Okay. So.
Oh, that was terrible. That was terrible. Okay. So I'm the
Listen,
host now. This is moving over to my channel.
That was an awful dad joke.
That was horrible.
That was god awful.
I
Kelly
tell my
just
share of
kinda-
dad jokes, but I wouldn't even gone that
Yeah.
way.
Kelly just left the chat.
Kelly's
I don't think it was
filing
bad.
for divorce.
It wasn't that bad of a joke. It was you guys are over. It wasn't that bad of a joke. It wasn't that bad.
All right.
Pull it up, Tanner.
Okay, so some of these things are. Oh, sorry, I can't seem to get it up. I gotta stop. I gotta stop. Okay, so this is. Amit's got to accept it. Okay, this is the fintech predictions. Now there are a bunch on here. Some of them just full on regulatory manners. Others in the crypto space. I don't want to dwell too long because we're running out of time
Tanner,
very quickly.
hit the reader button at the top right corner.
Okay.
Yes.
Perfect. Okay, so I do want to focus on a couple here. So obviously, you guys go check out Zachary Perret to get a bigger look at this. But I want to talk about the ones that are going to affect SoFi directly and not just fintech in general. I mean, obviously, we can have a discussion about that if we want. But most of the times we don't often talk about FedNow and these sorts of upcoming products. Oh, I can't touch anything while I'm in here. Okay. But I did want to talk about, let me find my space here. He says the pace of new fintech startup creations will be substantially slower for those that require partner banks or banking as a service providers. Now, if you guys know anything about Technisys, he's talking directly to us. Recovery in the pace of fintech formation expected in late 2023 or early 2024. Pretty much all he's saying here is just that the amount of new names that happened during COVID was insane. Just tons of new names were popping up, from extremely small businesses like Marcus, okay, like Frank, the JP Morgan one that just went under yesterday. Common Bond also went under.
It didn't go under. It was never actually a thing.
It was 30% a thing. I think 70% was a lie. I think,
Anyway,
around 30%
It was
real.
fraud.
Can we jump into that right after this though? Because I think that's interesting.
But so just so as we continue, not everything is great here on what he talks about, but he said the slowdown in new fintech formations will be made up by the continued push for big tech, retail, e-commerce, and the banks themselves to launch new wallets, lending products, and fintech tools. And I think that's super, super cool. One, because in Chris Lapointe's latest interview, sorry, Chris Hager, I did not mean yours. I apologize. The one that he did with Credit Suisse, he was actually talking about how they're in talks, not with small players anymore, but with the big guys, with consumer platforms and, big banking institutions. And then they're also looking to launch products like, lending products, rewards, all these things that would fit the bill for exactly what the Plaid CEO is saying. However, there is going to be a slowdown overall, right? So profitability will be the primary focus. Sorry?
I guess just on that point, the fact that there's going to be a fintech slowdown, it does hurt. It probably hurts Galileo revenue, right? Because we've got these 100 million accounts, and if fintech's kind of not growing at the same rate, those aren't going to grow. But at the same time, I also think it's good for SoFi in general, because now we're going to have an even bigger first mover advantage. I don't know of any other fintechs that are planning on or that have applied for a big charter. There might be some out there that I'm unaware of, right? I'm not keeping a pulse on
everything. Did you hear about that crazy Noto prediction where he said there's not going to be a new bank charter for a decade?
For
they won't even get one if they do apply.
And so, but the thing is that we're already SoFi is already so far ahead that if there's not going to be another wave of new fintech startups until the end of 2023, 2024, like at that point, we'll have been gap profitable, right? Like we'll have had this first mover advantage. And then as they come online, like hopefully at that point, right, we've got Technisys and Galileo lined up where it's a package deal that we can sell to all these new fintechs that are going to be coming online at that point, right? So short term, it's probably not the best for like near term growth, but actually long term, that's probably a good thing.
Yeah, and I forget which analyst said this, but they actually upgraded a lot of fintechs saying that, excuse me, because there's not going to be a lot of new fintechs, that the actual amount of market share that the existing ones are going to capture is actually going to go up because it's a harder space to actually try to enter right now, especially with the lack of VC money and these sorts of things. And this also goes directly into, late stage fintechs. I guess that's really pointing at, SoFi and the likes of these people. Profitability will be the primary focus for late stage fintech. This will lead to a focus on slower, sustainable growth and products that deliver short-term returns. Initiatives like internationalization and new vertical expansion will move slowly or be paused altogether. I immediately think of SoFi Singapore and SoFi UAE. Bender 9000 predictions for 2022 that didn't come true. He held those predictions into 2023. You know what? Zachary is now saying it might be held all the way through these multiple years just because that expansion is really not the focus right now.
If I could add one other thing real quick on that also. Yeah. One of the things I actually like about SoFi, and one of the reasons that like they had this plan in place from back when Noto joined the company in 2018 of this like 70-30 split, right? So the idea is that for every incremental dollar that SoFi makes, they want to reinvest 70 cents of that back into the business and then drop 30 cents to the bottom line. And he was talking about that. The part that I like is that they've been super consistent. So they had this plan. And during the time, so during 2020 and 2021, when it was like, grow your top line as fast as possible, growth at all costs, SoFi didn't waver from their plan. They said, no, the best thing long-term for us is to have this sustainable growth that we can maintain throughout the credit cycle. And we're not going to waver on that just because right now everybody wants us to grow like we're not going to start reinvesting even more in the business because we think this is long-term the best way that we can do this. And now we've completely shifted, right? And it's gone from growth at all costs to profitability at all costs and cut all your costs and do everything else. But SoFi hasn't shifted their mentality. And that's the type of management that I want to be invested in, is one that had a long-term goal and that isn't like driven about because the winds of change have come and investors have changed their own personal ideas about what makes a good company, right? They have the idea of exactly what they want SoFi to become. They have been executing incredibly on that vision, and they're not modifying their vision just because the market is telling them something else. Like that to me is actually super bullish, is that they've got this a management that I can count on to set a plan and to execute on it and to execute well and to not waver just because of outside pressure. Anyway, that's all.
Yeah, no, I was just going to say it's like to have a stock long term, like the way that I would like to invest, like the Warren Buffett style, is to not have any peaks and valleys. There's going to be rougher times in the industry, and SoFi has been going through a long one, and the fact that we can continue to grow during that time is incredible. But you know what? If we can actually just continue to focus on what's important and actually get out onto the other side, we could be in a much better place in terms of the rankings of fintech or online only bank options for people way down the line. Let me just rush through this just because there's not too much left, and then let's do one last thing. So this is all just crypto stuff, which SoFi is trying to get out of. He said loan volumes will remain depressed. Lenders will focus on efficiency. After years of high volume lending, lenders will retranche, meaning just slow down their spending, and expect to see an increase in digitalization as lenders hunker down and focus on cost efficiency in 2023. Serving and loss mitigation will be a core focus for lenders. With forbearance and borrower assistance coming to an end, delinquencies will return and even surpass pre-COVID rates. We'll see a deeper focus on risk management and more use of data and monitoring loans. I know Riley's probably just, his ears are peaked up now. Data? Okay, sorry.
And we actually saw this yesterday. Lending Club announced that they were cutting 14% of their staff, right? And they highlighted the idea that they want to be very cost conscious. So you're already seeing like he put this out, and like the same day they came out with that press release.
I'm just going to skip this fraud one really quick, just because it really doesn't pertain to us, and I just want to get through this really quick. He also says B2B fintech companies will continue to ramp up efforts to sell to banks. B2B companies, by the way, you should really think about also, Galileo now and their focus on B2B companies rather than B2C, that big switch last year. So over the last year, banks have been quite receptive to B2B fintechs as they look for products to accelerate their digital roadmaps. As we say at Plaid, banks are the biggest fintech companies. Anyway, that's it. And also they did a actual conference at Plaid, and I recorded the whole thing. So maybe I'll post that for you guys or send that around if anyone wants to see it. Any thoughts on that whole prediction for 2023 from a massive CEO in the fintech space for 2023? Hopefully it wasn't a little bit too scary, because obviously he said things are going to slow and it's going to be about cost management. But still, the diversification of B2B products and these sorts of things is where maybe Galileo can actually thrive. And it just seems like Anthony Noto keeps placing himself, this is what I said on my latest video, just always in front of the newest product or the thing that's going to be, actually the accelerant that year, right? So whenever student loans were closing down, we went to personal loans. If personal loans start to slow down, then we'll go to B2B and Galileo and these sorts of things. And whether that's in less of just small companies, now we're focusing on the big ones that will survive, the banks and a lot of the actual, embedded finance companies and everything along those lines.
Yeah, I guess just I wasn't I was interested by that thread, but I wasn't too impressed by too many of the insights from the Plaid founder, because we've heard some of the main ones that pertain to SoFi from different talks at the City Conference, the GS conference over the past couple of months from Anthony Noto and the executive team, because they're just on top of it in terms of correctly identifying the same trends that the Plaid CEO is also identifying for the upcoming year.
Now, the only thing that I think is different is that Chris, you said that Lending Club was either doing a hiring freeze or letting go of their staff.
So yeah, they're 14%. They're having a 14% RIF.
And that was the same day that Anthony Noto came out and said that they're hiring, right?
Yeah, I don't know. Within a day or two, Lending Club came out yesterday and said that. I don't know when Anthony Noto said that we were hiring.
And so I don't know. I think this was actually much different than. And by the way, Zachary Perret and Anthony Noto are very close friends. They talk a lot. They have business partnerships and everything. So
I think he's been on Anthony Noto's podcast.
Right, on Who Dares Wins as well. So
yeah.
Obviously they know each other. I felt like he was talking directly to SoFi in some of those comments. But I don't know if necessarily that's the way that Anthony Noto is playing this right now. I think that hiring more and I don't know. It doesn't seem like we are being extremely risk adverse right now.
Like I said, I think that they have their pathway forward, and they're not letting the macro environment dictate what the company does. I think they're doing what they think is best for the company, and they'll definitely pivot based on where they see the most risk or the most reward for their, for the things that they're investing in. But I don't think they let the macro environment dictate to them what they're going to do. That being said, so I do think there's going to be plenty of demand from people who want loans, right? That demand isn't going away, but it is. If you look at, again, Lending Club also said they pre-released Q4 earnings, and in part of that they said that they only did $2.5 billion in originations. That's down 30% quarter over quarter. And I would guess they didn't they gave revenue and earnings, and then they released that number, but they didn't give much detail apart from that. I would guess that the vast majority, so last quarter they were at 3.5 billion ish, and now they're at 2.5 billion. I would guess the vast majority of that $1 billion difference is in their marketplace, because some of the loans that they originate, they immediately sell and through whole loans channels and to other investors, right, to other banks and stuff. I would guess that the vast majority of that is from those people pulling back. So the demand from the investor side, from debt investors, I think is pulling back, which it'll be really interesting to see how that affects SoFi, because we do there is a limit to how much SoFi can originate if they can't continue to sell loans off of their balance sheet, right? Like eventually they will run out of cash. Well, they won't. It's not. Sorry, I said that wrong. They're not going to run out of cash. Let's be crystal clear about that, right? They will run out of capital that they can lend out. And so, anyway, Q4 will be really interesting to see how much they were able to sell, and how much more of a buffer they have to be able to continue originating at the rates they are.
Just while you're here in the last 5 minutes here, and I'd also like to...
Tannor, we can go to 11:15. We're good, so we have some time.
Okay, cool. But still, I still want to focus on this, and then I want to show you guys a page after if I have more time. But what I'd like to ask is, what are your predictions for Q4? Have you opened up about that? Or if you don't want to get into specific numbers, what are you looking for in terms of, like, what are some of the standout statistics that you want to see this quarter that is going to make or break this, this
So
earnings?
I haven't done a detailed dive or predictions yet. I probably will. At least personally, I don't know if I'll have time to write an article about it or anything. I think so. Historically, Q4 has been one of our better quarters for membership growth. I think that happens. It's because I think the reason for that is because it coincides with the NFL season, and so we get a lot more impressions just generally, and people hearing the name SoFi. I know that Riley and Tevis did a video on this earlier. I would tend to agree with them that I think we'll see more than 500,000 members. I don't know that. And again, they said last quarter that they might pull back on marketing, that they're happy with 400,000 or more. So that might not come true, but my gut feeling is that we'll get a little more than that. What I'm really looking for are those things. So I've got lots of questions as far as the loan book goes. So how much we're going to sell, I anticipate that they've guided for 6 to 7 months. If there's really pullback from whole loan buyers and in the securitization markets, they're not going to sell loans at a loss just to sell loans so that they can originate new ones, which means that you could start to see lending growth tail off a little bit until those investors come back. One thing that is a tailwind for SoFi is the fact that we've actually been raising our rates faster than competitors. So LC talks about this a lot. Lending Club talks about this a lot. They say the Fed raises rates, and then a month or two later, credit card companies raise their rates, and then a month or two after that, then we can raise our personal loan rates. And so they lag the Fed. And their CEO just was on a podcast the other week and reiterated that's what they're doing. If you look at SoFi's numbers, they're not doing that. They're actually front running the Fed. So we are raising the APR on our personal loans faster than we're raising the APY on our deposits, and faster than the Fed is actually hiking rates. So
why do you think that is? What's the strategy behind that?
So I think it's simply that SoFi can. Like the fact that we are gaining so many members every single quarter makes it so that we have this much bigger pool of borrowers to draw from. And so you can, and the other thing that's really bullish about that is we're still growing our originations, and we are raising our coupons faster than competitors. And at the same time, we're keeping the quality of our borrower the exact same. So if you look at FICO scores and if you look at average salaries, they're the same as they have been. So despite the fact that like SoFi has been, that's what when I say their execution has been really, really great, like almost flawless in a lot of ways, it's because of stuff like that. It's because if you look at the things that they're doing relative to their competition, they are pricing things faster. They are still growing originations. They are, their net interest margins are actually increasing, whereas like Lending Club is decreasing because they're lagging credit cards and because they're lagging the Fed. But again, all of this can be like, at some point they will run out of capital. Like you can't keep lending forever. There's a limit to the amount that you have between our warehouse lines and how much our capital leverage ratios in the bank and that sort of stuff, right? It gets into details that's not worth discussing right now.
Well, we have a lot more warehouse facilities. We do have a lot more warehouse facilities than we're actually using.
Yeah, at this point, there's still billions of dollars that we could go into. But for example, like last quarter, we grew our loan book by 2 or 3 billion, right? And we can only do that for 1 or 2 more quarters before we hit like a hard stop, and we couldn't keep growing at that same rate. And so a lot of the stuff that I'm going to be looking for is that. And then like that's kind of the geeky, nerdy stuff that I'll be looking at on a more general level, like kind of the KPIs that I look for. I want to see that cross sell is still going up. I want to see the memberships going up. I wish they gave more clarity on the technology segment. There's so few numbers in the 10Q to be able to actually pull out what like who these clients are, what like how they're monetizing the revenue. So it's really hard. And unfortunately, we don't get a lot of detail there. And then on the financial services side, you won't see it as much in this quarter. I'll be looking in Q1 to see kind of what an effect options trading has. And hopefully they'll get out, level 1 options before then also to help out with that. But I guess that those are kind of the things right now that I'm looking at. And deposits. I really want to see how much we've grown deposits. I think that it will have, like, if you look at it, it's been really linear. I think it's going to stay at that level or possibly accelerate, and it'll be really interesting to see.
Yeah, I remember seeing that tweet that you put out of the linear deposits and where you thought that it would be as of today. If you remember doing that.
Yeah, I could.
I think it was like 6.7 billion at the time, but that was weeks ago. Yeah, no,
can I ask a question real quick to Chris? So we were trading in the $4 to $4.80 range for a while, and then we broke out, I guess, because of the CPI rally. I mean, I know it's hard to speculate, but do you think that's a little bit of a bottom we have formed? Do you think it could possibly go back under 4?
I mean, I hate to talk about where the stock is going in the near term because I suck at it, right? Like, yeah, I don't know. Like, it is interesting. The entire lending fintech really rallied. So if you look at, and I tweeted this today, but Upstart gained more this week than they have in any other quarter or any other week in the entire history of their stock in terms of like a percentage gain, except for their earnings weeks and one other week. And Affirm gained more this week in percentage terms than any other week since they've been a public company.
37%.
And Affirm, that includes the week that they announced that they had a deal with Amazon, that they were going to be Amazon's buy now, pay later vendor, right? Like, and Affirm didn't have any news, not a bit this week, right? And so like fintech lending in general had a great week. And I don't know the reason why. Like the 10-year didn't move very much. The 2-year didn't move very much. CPI came in line. Like it could just be that it was washed out.
It could also be like tax loss harvesting, people getting back in. But it was mainly macro. Like there's so many companies that are just moving in lockstep together as a whole. So.
But even if you look at the rest of fintech, so Coinbase had an incredible week too. It was up like 40% or something. But most like Square, PayPal, Marqeta, all these other ones that aren't specific to lending didn't move as much as us in Lending Club and an Upstart and Affirm.
It kind of makes sense though, Chris. Like if you buy into this idea that it's the people who were tax loss harvesting who are sort of entering back into these high ROI, high risk stocks. The ones that were the most beat up in 2022 are the ones that are going to have the biggest rallies in the first couple of weeks of January.
Right. But then like Marqeta was just as beat up as the rest of them. Right. And it only went up like 8% or something this week. So anyway, that was just my observation. I do think like personally, I think it was criminal. Like I can't imagine looking at SoFi, the company, and the valuation of it and having it be at $4.20 and thinking I should sell this company. Like that just seems so irrational to me, like based on fundamentals that like, if you ask me, should this be the bottom? I would say yes. If you ask me, is it the bottom? I would say I have no clue.
Can we talk about Frank?
Oh yeah.
This whole like JPM stuff.
Okay, wait. Can I just delay that really, really quick? Just because I saw a comment talking about how much SoFi's products have improved this year. And then we'll move on. I'll have all those pictures ready. This will just take no time and I just have it up right now. Okay. Do you guys mind?
Go ahead.
Okay, so this is Nerd Wallet, or what I'm going to show you guys. Pretty much, they get about 19 million monthly unique users to their website. And they just put out, just last week, their best of 2023. That's for all of their products. Okay, so this is pretty much it. Just searching for SoFi here, it comes up 7 times. Last year, it came up twice. So in the checking account department, best checking account, best for high interest, best for no monthly fees, best for overdraft fee avoidance, and then obviously the best checking and saving account combo. So whenever they write articles onto their website for their 19 million monthly unique users each month, obviously SoFi has been showing up on that. Credit cards, we didn't show up. Obviously, Riley is, understands that. Best insurance, best investing, obviously not. We're probably on the worst investing platform of 2023 or 2022. Mortgage lenders, that's something that we need to fix. And then personal loans. Now, best for good to excellent credit, and the best online personal loan in general, which is, I think, the most exciting award that we've gotten from NerdWallet. Obviously, this is one blog. Kyle, the stock goat, had said that Bankrate had also rated us number one in Forbes advisors as well. However, I couldn't seem to find that anywhere. I mean, I could find it like relatively, but I couldn't necessarily say it was number one. I mean, we placed in the top 10 of all these fintechs, and I don't know. But
there was
yeah,
a
go ahead.
question if one of these rankings are paid for. They are unpaid for. So if you go on NerdWallet's FAQ, they specifically say no, these are independent and nobody is paid in order to get these rankings. So these are, independent third party. The people at NerdWallet feel that it's the best.
Yeah, well, yes. So we're not sponsoring those awards. However, NerdWallet's whole business is to get affiliate income. So obviously, whenever people go through NerdWallet and create memberships and or they become members and get products, we are paying NerdWallet to get those customers, but not as a general sponsorship. But that's with every single bank and every single fintech that's also on that list. So we don't stand out in any
revenue, right?
unique way.
I love the fact that in each one of those categories, there's a lot of fintech companies that are competing against each other inside the category. But if you look at all the categories, SoFi is trying to take them all, which is just so exciting.
Yeah, right. Which is funny considering that some people specialize just in checking and savings, and this is a relatively new product for us like this year. So, it's kind of funny to know that we took 5 of those spots. So you were talking, Tevis, about
Frank.
a couple of, Frank. I'll bring up this article here if you guys.
Tevis had a good point. He says legacy banks name their newest products after old white men. Marcus.
They're all named. They're named after the founders.
Well, Frank wasn't named by J.P. Morgan. It was.
How else are you going to
somebody
appease
else.
the people that have been there for decades and they don't want to add the risk of doing a tech startup within an old traditional bank?
It makes me think of why are they all named just names? Like Dave, Marcus, Frank. There's way too many of them.
Money Lion. Just kidding.
Sounds like all the old search engines back in the early 2000s, just goofy.
Right.
I used those. See, none of you guys used them. You're all way too young for that. I remember using Alta Vista.
In Jeeves.
Yeah, I asked Jeeves lots of questions.
No one's old enough here to actually have used like Mosaic or something, right? No,
I could have, but I didn't.
Yeah, I used it for a little bit. I was really young.
You did not use Mosaic.
I did use Mosaic. That was like 1999, right?
I love the argument while you put this up. I love the argument that we've heard in 2022 is so SoFi is trying to do something. Why all these big traditional banks? Why they can just compete compete with SoFi because they have just endless pockets, and we're seeing these big banks fail in so many tech-oriented projects. Tannor, you want to go ahead?
Yeah, so I just want to speak to Amit's point because he's a filthy liar. And
so I was just going to say 1999. I mean, I know your age, dude. You were like 3.
No, he was 2.
Bro, we had a
I got at
computer in
least
my
a
house.
decade on all y'all.
He was 2, and it didn't even excel there. It came out in 93 and kind of dominated till like 97-ish, and then Mozilla Killer or whatever, well, actually, it was just called Mozilla, and then Internet Explorer. But anyway.
Yeah, I remember opening up Netscape to Alta Vista to do my searching.
Right. That'd be an interesting conversation. I love just following VCs and stuff. I need to find people that will talk to me about this nerdy finance stuff, like go over Mark Andreessen's life. But anyway, This is Frank, a student loan refinancing company, if I remember correctly. They had 4 million, nearly 4 million fake accounts out of the 5 million that they had total, or something along these lines. They
And
sent
I
out a
don't think
batch
it was, so I actually don't think it was a student loan company, but like it was a financial aid. So like you could go on and you could get help with, filling out your FAFSA and anything else you needed like help with as a student. But I don't think they
Gotcha.
were specifically a lender.
Okay. Well,
I might be wrong. That was
regardless,
my impression from the article.
they closed down. This was one of JP Morgan's things. They're suing the founders to the end of the earth. But Frank is gone now. Frank stepped down. Marcus is stepping down, not completely, but from the, if I remember correctly, the consumer-facing side. That's not extremely high end. So I know that Goldman Sachs, for some of their higher end customers, they're still going to allow to use this product. It's something that IP Banking Research brought up in his article whenever he did release it. Look at Chris look over. He can't wait to talk about this. But pretty much that they couldn't actually find a road to profitability. However, they did find, some successes in deposits and these sorts of things. This is what IP Banking Research had talked about. But he said that because Marcus couldn't do it, that, it's a failing business model or something along these lines, even though like Lending Club is doing perfectly fine and SoFi will be doing perfectly fine in, a year from here or whenever.
So I have one single question on Frank, and then we can jump to something else, because the number one thing I found interesting about that was they found out months after the transaction closed, after they sent 400,000 emails and 70% bounced back, and they paid 175 million in 2021 to buy this company. Where was the due diligence? Like, where was, can you imagine the layers of bureaucracy you would go through to buy a $175 million financial institution? And they didn't even test to see if the accounts were legit. Like, I don't know. That baffles me.
People get on our case for paying what we did for Technisys. At least it works. At least it's not fraud.
Do we know that? I'm not trying to be a bear here, but
I'm pretty certain it's not fraud.
Right. Yeah, no, we have some pretty big clients through Technisys. So
legacy banks don't do due diligence. I don't think it's that they don't do due diligence. I think 2021 in general was a crazy funding environment where they probably just wanted to get deals done. And
I mean, SBF got through how many years and how many VCs and how many like financial backers and crazy stuff.
It was funny hearing how that all broke down, where it was kind of just big group think, where Sequoia didn't do their proper research because SoftBank was already in the investment, and then like Kevin O'Leary's funds didn't do proper due diligence because Sequoia was already there, so they must have done it, and then no one was thinking for themselves and just all got burnt. Really, really sad.
One last comment. So I went back to my spreadsheet, Tanner. If we continue that linear trend, we would have been at 7.3 billion deposits as of
today?
December 31st. As of December 31st. So our Q4 number would be 7.3 billion.
That's the number to beat, guys.
Dang.
Yeah. I mean,
all right.
So like what is sort of the idea of how we're going to beat deposits? Like do you think that
I think
obviously all the
growth,
legacy
right?
banks are going to continue to get crushed?
I think most of the people who are signing up are probably going to be direct deposit members because of the amount of APY that we're offering. That's
from
my
Q3,
thought.
it was 85%, if I remember correctly, the deposits that came from
really
direct.
high. And so I think most of the new members end up being direct deposit members, and so it should be slightly exponential. I know Amit's got to go, so he's getting that look in his eye, like, guys, you better wrap it up.
It's okay. Darth Chris usually comes in the chat and they go Palantir, and then we know we have to go.
I do have to go, but the reason I'm getting that look in my eye is like this hand. I feel like I have carpal tunnel. Like it's been hurting all day. I don't know. So I've just been like
Ben Gay, Amit. Ben Gay.
Oh yeah, Ben Gay. It's just been hurting a lot, so I don't know. That's why I've been fidgety. But yeah, this was a great episode, Chris. Thank you for coming on and explaining everything about this article. I mean, this article kind of took us by storm this week. You tweeted it and just like everyone was like, "Yo, there's this new thing. We got to get through it. We got to see what research is up there." And the fact that, I think one thing we didn't talk about is that the fact that SoFi gave a retail investor 15 minutes of a very high level executive's time. I mean, Palantir hasn't done that. So
again, I felt like it was his dollar waiting on my dime, right? Like I was like, I can't, like, the amount of money that was being spent on his salary during my 15-minute interview, you know, like I was just like, anyway. But I do think it, like, the fact that they're willing to do that shows me that they actually do care. Like, they knew I was a retail investor. They knew that I only write to retail investors, right? Like the people who read Seeking Alpha articles aren't like, I mean, I don't know who does, but for the most part, like, it's people like us, right? Yeah. And I'm obviously a person like everybody else who's in the chat, and they did that because they care, and that's awesome.
Yeah.
Yeah, I just want them to come on the show. I mean, we already confirmed that they watch it, so just come, like, the incremental, you know, from watching it to being in the chat to just come, it's just a link away. So I don't know.
Oh, there Matt Money is. This show isn't important enough to delay Palantir Weekly. See, I told you they'd start flooding in.
We got to get it. I think we had 200 people here for we got to get more than 200 for Palantir. That's how we'll know which one matters more, which cult is better. That's the other thing too, is if we do get Noto on here, we will, like, legally not be able to say shit about the stock. So we'll literally just be asking him such good questions, you know, about his life and shit. I mean, we'll probably throw a couple hard balls, but, you know.
Who do you think's going to win the Super Bowl this year?
Yeah, he's gonna be. Yeah,
he would love to talk about that.
I mean, you can talk about the company, just not the stock. There's lots of questions, like publicly available stuff.
What player are you in SoFi?
Are you the quarterback, or are you? That's awesome. All right, so we're out. Thank you. Yeah, we're not
Chris.
We're not gonna read it. All right, that's so bad, Chris, because you actually like Notos. I don't know.
Wild.
All right.
Jesus.
All right, we're out, everybody. Thank you for joining. Thank you. Oh, Chris, by the way, you're starting a YouTube channel, right?
I've thought about it.
Do it. 5 kids, articles.
All right, when you do, we will pump it on this channel.
The problem really is that I can't do YouTube videos because while I'm putting my kids to bed because the room's dark, right? So when am I gonna? I don't have time for it.
Just whisper the whole video.
I can whisper it into
ASMR.
my phone.
It'll be ASMR. It'll be good.
You guys can have white noise. There's white noise in the background, so you guys can all just listen to the white noise.
Honestly, that's funny. Babies in the background, stock-based compensation, just ASMR. Oh man.
All right, everybody, we're out. We'll see you next week.
See y'all.
Thanks, y'all.
Bye, guys.
Bye, guys.